Something extraordinary just happened in the gold market, and I want to break it all down for you right now. Because if you understand what's really driving this move, you'll understand something far more important than just today's price action. You'll understand a structural shift in the global financial order that most people won't recognize until it's too late to act on it. Here's the thing: most people wake up, see a headline that gold jumped 5% overnight, and they think, okay, some hedge funds moved some money around, maybe some news happened, it'll pull back tomorrow. And then they go about their day. But that's not what this is. What happened overnight is the latest signal in a chain of events that has been building for years. And the people who understand the full picture are the ones who are going to come out of this era with their wealth intact. So let's start with what actually happened, and then I'm going to take you several layers deeper into why this moment matters so much. In the overnight session, while most Americans were asleep, gold made a massive move. Trading desks in Asia and London were scrambling. Volumes surged. The move wasn't the result of one event. It was the result of several converging forces that had been building pressure beneath the surface for a long time. Think of it like a fault line. The tension builds slowly, invisibly, and then, without warning, the earth moves. Here's what was happening underneath the surface. You had the Federal Reserve, under its new chair, Kevin Warsh, holding interest rates steady while signaling that some policymakers still want another rate hike on the table. Now, on the surface, that sounds bearish for gold. Higher rates mean higher opportunity cost for holding a non-yielding asset, right? That's the textbook. But the textbook was written for a different era. Because here's what the market heard when the Fed spoke. They heard that despite holding rates, inflation is still unresolved. They heard that the monetary authorities are essentially trapped. They can't raise rates aggressively without triggering a debt crisis in a country carrying obligations north of $35 trillion. And they can't cut rates without reigniting the very inflation they're still fighting. That is a checkmate position, and gold knows it. Then overlay on top of that the geopolitical dimension. The situation in the Middle East, particularly around Iran, has been creating enormous uncertainty. Energy prices have been volatile, which feeds directly into inflation expectations. And inflation expectations, even anticipated future inflation, are rocket fuel for gold. Because gold doesn't wait for inflation to arrive, it prices in the probability of it. And right now, the market is pricing in a world where the purchasing power of paper currencies continues to erode, maybe slowly, maybe not so slowly. And there is one asset that has stood as the antidote to that erosion for literally 5,000 years. Before I go deeper, real quick, if you're watching this and you're in or near retirement, I put together a free guide in the description below. It covers how thousands of American retirees are using specific saving strategies to protect their hard-earned wealth from exactly the kind of environment we're seeing right now. It's completely free. Check it out when you're done watching. Now, let me explain why this overnight jump is not an anomaly. It is a symptom. To understand that, you have to understand what has been happening at the institutional level. Central banks around the world, not retail investors, not hedge funds, not retail traders sitting at home. Central banks, the institutions that literally create money and manage the financial reserves of sovereign nations, they have been buying gold at a pace that has no modern precedent. What we are watching is a geopolitical repositioning disguised as portfolio management. Think about what happened in 2022. When Russia invaded Ukraine, the United States and its allies froze Russia's dollar reserves. Over $600 billion rendered inaccessible overnight. Not confiscated, frozen. And every finance minister, every central bank governor in every country that doesn't have absolute alignment with Washington looked at that and thought, that could happen to us. That moment changed the calculus of reserve management globally. If your reserves can be frozen by another country's political decision, then they are not truly your reserves. They are a liability disguised as an asset. Gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be hacked, rerouted, or politically weaponized. And so countries like China, India, Turkey, Poland, the Gulf states, they have been methodically, quietly, and relentlessly converting dollar reserves into physical gold. China's central bank alone has been on a buying streak that has lasted for years. And when the largest economy in the world is systematically shifting its reserves away from dollars and into gold, that is not a trade. That is a statement about the future of the monetary order. The dollar's share of global foreign exchange reserves has been declining. The research is clear on this. It has fallen meaningfully from its peak. And gold holdings by central banks globally have risen to levels that are approaching parity with US Treasury holdings for the first time in modern history. Let that sink in. The asset that the financial establishment spent decades telling you was a barbarous relic, John Maynard Keynes' famous phrase, now holds a place in global reserves comparable to US Treasuries. That is not a coincidence. That is a verdict. And this is where the BRICS dimension becomes critically important. The BRICS nations, Brazil, Russia, India, China, South Africa, now expanded to include Saudi Arabia, the UAE, Egypt, and others. Together, they represent the majority of the world's population and a massive share of global GDP. And they have been consistently, on a policy level, discussing alternatives to dollar-denominated trade settlement. They are buying gold, not just as an investment. They are buying gold as a potential foundation for a new settlement currency or as an alternative reserve mechanism. You might think this is years away from mattering, but the buying is happening right now. The price impact is happening right now. The overnight move you just watched, part of that is global de-dollarization playing out in real time. Now let me take you back in history, because this has happened before. Not exactly this way, but the mechanics are hauntingly familiar. On August 15th, 1971, President Richard Nixon stood before the American people and announced that the United States would no longer redeem dollars for gold. The world had been operating under the Bretton Woods system, where the dollar was backed by gold at a fixed rate of $35 per ounce. Nixon ended that unilaterally to manage mounting debt from the Vietnam War and a growing trade deficit. Most Americans had no idea what that meant at the time. They went about their day. But the people who understood monetary history, they understood that the anchor had just been cut. And over the following decade, gold went from $35 an ounce to over $800 an ounce, over 20-fold. The asset that was supposedly a relic, supposedly dead, performed unlike anything else in the investment world during that era of dollar debasement. Then came 2008, when Lehman Brothers collapsed and the global financial system went into cardiac arrest. Gold initially sold off, because in a panic, everything gets liquidated to raise cash. But then something interesting happened. As the Federal Reserve began its extraordinary monetary expansion, printing trillions in new money through what they called quantitative easing, gold began an ascent that doubled its price over the next 3 years. Institutional investors, sovereign wealth funds, and ordinary citizens who understood inflation realized that when a central bank dramatically expands the money supply, it is diluting the value of every existing dollar, and they moved into gold as protection. We are now living through an expansion of central bank balance sheets that dwarfs what happened in 2008, multiple times over. The money printing that occurred during the pandemic era was unprecedented in the history of modern central banking. And while some of that inflation has moderated on the surface, the damage to the purchasing power of paper currencies is not reversible. Once money is printed, it does not unexist, and that long-term erosion of purchasing power is baked into the future. Gold is simply pricing that in. Now, here's something that doesn't get enough attention, and it's crucial for understanding why the overnight move happened the way it did. Let's talk about the mechanics of the gold market itself, specifically the relationship between paper gold and physical gold. The majority of gold trading in the world happens at the COMEX in New York and the LBMA in London. These markets trade paper claims on gold, futures contracts, unallocated gold accounts, derivatives. The total notional value of paper gold traded daily at these venues is orders of magnitude larger than the physical gold that actually exists to back it. For every ounce of actual physical gold that exists, there are many more paper claims on that ounce floating around in the financial system. This works fine, most of the time, because not everyone demands delivery simultaneously. It's similar in structure to a fractional reserve bank. It works until it doesn't. And what happens if a large enough number of institutions, particularly the central banks that are buying physical gold right now, start demanding actual physical delivery rather than paper settlement? The paper price and the physical price begin to diverge, and the paper market, which has historically suppressed gold's price by allowing unlimited synthetic supply, begins to lose its grip on the physical market. There are analysts who track the difference between spot gold prices and the premium being demanded for physical metal. There are periods where refineries have reported extended backlogs. There are dealers who have reported unusual strains in supply. These are not mainstream headlines, but they are the kind of signals that precede large, dislocating price moves in the physical market. When paper and physical gold disconnect, and there are structural reasons to believe that pressure is building, the price discovery that has been anchored by paper markets could shift dramatically upward. Now, I want to talk to you directly about what this means if you're watching this from the perspective of someone who has worked hard, saved hard, and built a retirement account over the course of a lifetime, because this is where this becomes personal. The conventional wisdom for retirement saving has been put your money in a diversified mix of stocks and bonds, let it compound over time, and you'll be fine. And for much of the post war era, that was reasonable advice. But that advice was built on a specific set of assumptions about dollar stability, assumptions about low inflation, assumptions about a global order where the United States dollar is the unquestioned reserve currency. Those assumptions are not what they were. If you are sitting on retirement savings in a traditional IRA or 401k, you have an exposure problem that most financial advisors are not talking about. Every dollar in those accounts is a claim on the future purchasing power of a currency that is being eroded from multiple directions simultaneously. Inflation from one side, debt monetization from another, de-dollarization applying structural pressure from a third. And this is why I want to briefly mention something for those of you watching this who are in or approaching retirement. A gold IRA, an individual retirement account backed by physical precious metals, exists specifically for this situation. It allows you to hold physical gold or silver inside a tax-advantaged retirement account. Not a paper gold ETF, not a mining stock, actual physical allocated metal. The same kind of metal that central banks are stacking right now. The same kind of asset that has preserved wealth through currency collapses, world wars, hyperinflationary episodes, and financial panics across 5,000 years of human history. There are rules about how to set one up properly, how to do a rollover without triggering tax events, and what types of metals qualify. If you have retirement savings of $100,000 or more, it's genuinely worth understanding how this works. I'd encourage you to check the description. I have a resource there that walks through the basics. This isn't advice, it's education. But given what we're watching in the gold market right now, and what we've covered in this video, I think it's education worth having. Now, let's get back to the analysis, because there's more to unpack. Let's talk about where gold goes from here. And I want to frame this carefully, because price prediction in any market involves genuine uncertainty. But I can tell you what the institutional analysts are projecting and why, and you can form your own conclusions. Goldman Sachs, one of the most influential trading houses on the planet, has issued forecasts suggesting gold can reach levels significantly above where it trades today. Bank of America has set targets that would represent an almost doubling from the levels of a year ago. These are not fringe voices. These are the institutions that manage trillions in client capital, and their analyst teams have the resources and access to information that individual investors simply do not. When Goldman Sachs and Bank of America are pointing to dramatically higher gold prices, they are not guessing. They are reflecting structural realities in the market that their trading desks are already positioned around. The technical picture reinforces the fundamental one. Gold peaked at its highest levels earlier this year, above $5,000 per ounce, before pulling back significantly on a combination of Fed hawkishness, geopolitical stabilization hopes, and profit-taking by institutions that had built large positions. That pullback brought gold back into a range that many analysts view as a reloading opportunity before the next leg higher. The key question for where gold goes is essentially, does the structural case for gold remain intact? Does de-dollarization continue? Do central banks keep buying? Does fiscal spending remain elevated, keeping debt expansion on its current trajectory? Does geopolitical tension persist in multiple regions simultaneously? If the answer to most of those questions is yes, and right now there is very little evidence suggesting any of them are reversing, then the medium-term case for gold to reclaim and exceed its previous highs remains very much alive. And there's a silver story embedded in all of this that deserves its own attention. Silver has historically lagged gold in the early stages of a metals bull market, then dramatically outperformed in the later stages. Miners call it the gold-silver ratio. When that ratio is extremely elevated, meaning gold is trading at a very high multiple to silver, it has historically been a signal that silver is due for a catch-up move. And the catch-up moves in silver, when they happen, have been historically explosive. In 1980, when gold peaked, silver hit $49 an ounce. In 2011, silver briefly touched nearly $50. The silver market is smaller, thinner, and more volatile. It has massive industrial demand from solar panels, electric vehicles, semiconductors, and medical technology, on top of its monetary demand. The combination of constrained supply, surging industrial consumption, and growing investment demand creates a structural case for silver that is, in some ways, even more compelling than gold's over a longer time horizon. What we are watching play out in the gold and silver markets is not a flash in the pan. It is not speculative mania. It is the slow, grinding, inevitable response of real world markets to a monetary and geopolitical environment that has fundamentally shifted. The central banks know this, the sovereign wealth funds know this, the institutional asset managers know this, and increasingly, informed individuals are recognizing it. The overnight move that started this conversation was a reminder that the forces driving gold are not resolved, that they are, in fact, intensifying. The Fed is trapped. The dollar faces structural headwinds. Geopolitical realignment is accelerating. Physical demand continues to strain the paper markets. And the historical parallels to 1971 to 2008 to the broader story of every currency that has ever been debased by the sovereign power that created it all point in the same direction. What you do with that information is up to you, but knowledge is the first form of protection. Understanding what is happening is step one. Acting on that understanding, in whatever form makes sense for your situation, is step two. If you've watched this far, you're clearly someone who takes this seriously, and I want to give you something valuable for that. I mentioned the free guide at the beginning of this video. It's in the description. But for those of you who have watched all the way through to this point, here's something even more specific. If you are an American retiree with $100,000 or more in any retirement account, a traditional IRA, a 401k, a 403b, anything, and you mention that you watched this video, there's an opportunity to get a free one-on-one educational web conference with a specialist who can walk you through exactly how gold IRAs work, what the tax implications of a rollover look like, and how you would actually get physical metal into a retirement vehicle. No obligation, no sales pressure, purely educational. It's designed for people who are in the position where this actually matters for their retirement security. The details are in the description. That offer is specifically for American retirees who meet that threshold. The gold market just moved in a way that woke up a lot of people overnight. The question is not whether this was significant. It was. The question is whether you're going to understand why and think carefully about what it means for your own situation before the next move happens.